All right, what's up, everybody? This is Rob Scow here with Living in Southern Maryland. Today, we have Matt Baden back on the podcast, and we're going to be talking about mortgage rates. So we have some high mortgage rates, as everyone's aware about right now. There's no real dancing around that issue. Right now, currently, as we're recording, I think I'm right when I say this, Matt, they're in the 6.75% to 7-ish range. Is that right?
Yeah, that sounds about right. Let me pull up my daily national average. So, daily national average for a conventional 30-year fixed rate is 7.05. And then, again, that's an average. There's going to be some that people are qualifying for a lower rate. There's going to be some people qualifying for a higher rate. That's your average no point rate right now.
And so then that brings us kind of the thing I want to talk about today. And I think there's ways to deal within this like higher interest rate environment that could help a lot of buyers and even sellers that are going to be buyers after they sell, of course, maybe navigate this higher rate environment. And two of them are going to be the 2-1 buy down or any variation of that buy down, but then also just buying down the interest rate for the life of the loan too. So what we're going to do today is talk about those. And I'm really going to depend on Matt to really inform you. I have working knowledge as a realtor, but I always trust experts like Matt to give me this kind of information and really explain it well. So he's going to start with the 2-1 buy down and kind of explain what that is and how it can help you maybe feel more comfortable up front with that house you really want to buy.
All right. Thanks, Rob. So pleasure to be back again, guys. And again, looking forward to doing this on a regular basis and sharing some knowledge. So 2-1 interest rate buy down is what we would call a short-term or a temporary rate buy down compared to the traditional rate buy down that is permanent. So benefits for a 2-1 buy down is you get a significantly discounted rate at a 1 year and a 2 year period. So the first 12 months, you would get a interest rate that is 2% lower than your base rate. The second 12 months, so 13 through 24, you would get an interest rate that is 1% lower than your base rate. So that is significant savings for a monthly payment for those first 2 years. And the reason, this is something that is beneficial for clients right now, somebody that might not be planning on living in a home for a long period of time, maybe someone who is on short-term orders for the military. They might only be here for 3 years. So, why not take advantage of guaranteed discounted rate for the first 2 years? In this current market environment, we still do have the majority of the talking heads projecting the next 12 to 24 months to see some interest rate reprieve. So with that said, we say, let's get the best monthly payment we can right now with a 2-1 interest rate buy down, so lower interest rate. So for example, if your base rate is 7%, which is the base right now, year 1, your interest rate would be 5%. Year 2, your interest rate would be 6%. So significant savings. I don't have exact numbers off the top of my head, but we're talking hundreds of dollars a month when we're lowering that interest rate by 2%.
And then the worst case scenario after that 3 years, if you don't refinance, you're just going back to the 7%
Correct.
that your original loan was. And if I'm not mistaken, and correct me if I'm wrong, because like I said, you're the expert on this, you're being qualified for the 7% payment. You're not being qualified off of what that 5% and the 6% is. So in theory, you're going to comfortably able to afford that 7%. So at the worst case scenario of doing a 2-1 buy down is you go back to the 7% that you already have qualified for, and you should be able to comfortably, work within your normal life. And hopefully what you're doing at those first 2 years is putting some of those savings aside or putting them in other places that can help you be even better off when you hit that third year, if you get to that point.
Exactly. That's exactly it. It's always qualified at the base rate. So whether, a client feels comfortable at that rate or not is sometimes a different story compared to what we might consider as a qualifying comfort, because at the end of the day, we always look at what is comfortable for the client, not what's comfortable for what they qualify for. So yes, this is an example where it may help a buyer have that monthly payment be a little bit more palatable going into a new home purchase, where they're either going from renting, where maybe rent was a little lower, but they're buying and this payment is a little bit higher. But with the buy down, we can, adjust it, get it a little bit lower allow them to ease into a higher monthly payment. And with the benefits of owning, appreciation, equity, all those items. And then also, one of the great pieces of the 2-1 buy down is, with the market projections of improved interest rates at some point, if rates improve to an extent that it's beneficial to refinance and lock in a lower rate more permanently, the buy down cost for the cover the interest for the lower rate is held in an escrow account. So if you refinance prior to 24 payments, however much of a balance is left in that escrow account, it is applied to the principal of the loan. So you're not losing that buy down cost compared
Gotcha.
to a permanent interest rate buy down. If you pay 2 points to lower your interest rate from, let's say, 7% to 6%, which could be considered kind of a reasonable option, permanently getting it to 6%, those 2 points on, let's say, a $500,000 house, that's $10,000. If you refinance before you recoup that cost, which in general is about 4 to 5 years of time to recoup a buy down of that extent, you would lose that money. Say if you refinanced at 2 years, you don't get any of that back. With this short-term buy down, since it's held in escrow, you would if you refinance before the 2-year kind of break-even point. So it's another kind of safety net for a buy down without putting all your chips on the table and hoping that it's not going to work.
And so to go back, you mentioned points, and points are normally 1% of the loan, correct? 1% of the sales price.
1% of the loan amount. So whatever
1% of the loan amount.
Mm-hmm.
So that's really neat that in a 2-1 buy down, and I didn't know this honestly until we started talking today, that it basically is escrowed. So that amount that you're buying down in a 2-1 buy down, and from right, is sitting in that escrow account, and can it either is refunded to you once you refinance, or it's applied to the refinance, I would assume.
Correct. Yeah. So there's 2 avenues of a 2-1 buy down as well. If we get a little into more of the nitty gritty, a seller paid 2-1 buy down, or a what's considered a lender paid 2-1 buy down. So lender paid is basically just, you have the interest rate and you have the point cost. The point costs are what's kind of covering the lender side of that buy down. And if you have the seller pay it, basically they're paying in seller credit towards the buy down for the buyer to help them, qualify for the house at that point. They're qualifying at the higher rate, but feel more comfortable buying.
Feel more comfortable. House. That's a great way to say it, because I've had people use the 2-1 buy down, and it wasn't that they couldn't swing the payment. They didn't qualify for it. They just wanted to feel more comfortable with it, and it was more of a almost like we missed out on the really low interest rates of a few years ago, and it really sucks to pay 7% was what they thought. And so doing this 2-1 buy down was something that got them closer to a payment they felt comfortable with. And like you said, a lot of these, and you're not seeing a lot of concessions still in this market, but one that I've seen sellers be more willing to work with buyers on are the seller credits towards the 2-1 buy down. I think everyone understands mortgage rates are higher right now, and everyone's willing to help each other kind of get to that point. So I'm seeing that be a concession that sellers are more willing to consider.
Yeah. And I think at the end of the day, if everybody can kind of work together, If you have a net number that a seller wants to get, um, you know, starting off at negotiations on a sales price with a contract, and you say 500K was what we want our net to be. Well, if it's going to be a $10,000 cost, let's just say, for example, for the 2-1 buy down, if the seller provides the funds, well, let's make the contract 510.
Yep.
Seller's happy, buyer gets that. That's a pretty close number. Most of the time, it's going to appraise, as long as it's not some odd kind of scenario or property that doesn't have comps. And then, those funds, even though, the buyer's financing $10,000 more, they feel more comfortable. And at the end of the day, they're saving money on a monthly basis, to pay for that house.
So then the permanent buy down is different because that rate's bought down for the entire length of the loan. So for 30 years, if
Correct.
you're doing a 30-year fixed. And so that makes more sense, I'm guessing, for people who plan on staying in their home for a certain period of time, or does it really, if we're projecting, and like you said, it's talking heads, we don't know for sure. And no one can tell you when interest rates are going to drop. They could decide to drop tomorrow and it could change. But is there a way, or is there a scenario that you would say, yes, go with the permanent buy down over the 2-1 buy down? Or is it just kind of?
Yeah, we look at the comparison of what the point cost to buy the rate down is, and kind of what that length of time for recouping it is. Some people just feel more comfortable. They want to be permanent. They say, I'm okay with only being able to buy it down 0.5% or 1%, but I know it's set at that, and that's fine for me. And if rates get better, I know I've paid more up front and I'm going to lose some money. That's fine, because I felt more comfortable up front. It's really kind of a personal preference, and we like to try to just provide the options and kind of advise people on, where the break even point is, and how these options would affect them. And then they can make the choice that's going to be the most comfortable for them. Because not everybody's going to be the same. There's people who are bigger risk takers. There's people who are the most risk adverse people in the world. And that's perfectly fine. What I might do or advise for my personal home purchase may be different than what a client might feel comfortable with. So that's why we don't really try to steer them in one direction or another. We just try to provide the best options, and then they can choose, what's going to feel best for them.
One of the common misconceptions I hear from a lot of buyers out there, and when you said risk, this made me remember it. They think a 2-1 buy down is the same thing as an ARM, an adjustable rate mortgage. Mm-hmm. And they're not the same, correct? Like, it's a totally different product that we're talking about there.
Yeah, totally different. And an ARM is another great option in some cases as well. The kind of I know we're taking a little bit different route here, but this led me into this. An ARM is going to be a great option as well as kind of a short-term, lower interest rate option, typically in a 5 or 7 year term. So it gives you a little bit longer time to allow things to shake out. But we typically see the most benefit when we're having a larger down payment with the ARMs. Okay. So 20+% down payment, you see a really great improvement on an ARM interest rate versus a standard interest rate, where the 2-1 buy down doesn't have that as much of a limitation. You can put the minimum down at 3%, or a VA loan 0%, and do a 2-1 buy down and still get that benefit without the large down payment.
That makes a lot of sense. I mean, like, I guess, and the whole point of this podcast today is just to tell people there are options out there. Everyone's got a little bit of sticker shock still from the 7%, and we get that, but there's options around that. And what we need to be doing is talking to each other and talking to people like Matt about the options out there, and really listening and figuring out the best situation to help you move forward if you're looking to move.
Yeah, I agree. I think, as a buyer, if you're working with, and this, not to name any specific companies or anything like that, but with a bank or a credit union or some of the bigger online companies, they tend to kind of put you in a cookie cutter style loan. When you start to work with a local lender that has more local options, different types of programs, different affiliations, us as a company, we work with, 20 plus other banks or credit unions as well and do loans with them or have partnerships with them, so we can shop around and see who has the best rate for your scenario and kind of customize that loan to fit your needs versus saying, okay, you're a VA loan. Let's just put you in this category. This is what you get. We can say you're a VA loan that wants to put 0% down. How can we make this regularly pretty standard loan even better for you?
Right. And I think that's one of the things whenever I talk to someone that's looking for, a loan officer, want to go with a bank, I always tell them not to go in and say, I want an FHA loan. I want you to go in and say what your situation is. Tell them, what your ideal payment is. Tell them what your ideal down payment is. And they're going to come up with solutions to your situation. Don't just go in there and say, I want an FHA loan, because there may be other conventional products. Maybe you qualify for a USDA, depending on where you're buying the house. There's so many options out there that people like you know that the regular public and even myself don't fully understand. So lean on those experts like Matt to really put you in the right situation for your situation, the right product for your situation.
Yeah, and I even just the basic misconception of, people think an FHA loan is a first time home buyer loan. Well, it's really just the Federal Housing Administration is the entity that backs the loan. It can be for anybody. So there's a lot of that, just out there for first time hires. We don't expect you to know everything, and that's what we're here for, to help you find the best fit. You don't. It's not our grandparents, or parents' loans anymore. You don't need 20% down. In our area, we're fortunate to be able to have a lot of 0% down loans with VA loans, with USDA loans, and here in Maryland, the Maryland Mortgage Program provides down payment assistance where, while there's technically a down payment, that assistance is, covering it in full in most cases. So you're a lot of times you're not coming out of pocket with any money, and you're buying a house. So there's a lot of options. Don't consider yourself down and out until you explore them. And even if you might not have the credit or, one piece of the puzzle right now, we can put you on the right path so that in 6 months, 12 months, 24 months, whatever it might be, you know what you need to do to get where you want to be versus just kind of giving up.
Exactly. Well, Matt, I appreciate you coming on today and kind of giving us a little bit of a alternative perspective of these high interest rates and how to kind of get around them. And of course, congratulations are in order for you for having the second born in the house now. You look well rested, and I'm kind of surprised by that, to be honest with you. Because I'm telling you, we talked about this a little bit before. It was one of the most tiring things ever having a kid. And it's pretty amazing to see you on here back in the office and doing what you do. So I appreciate you coming on today.
Yeah, thanks, Rob. This is my first day back. I'll probably stay home again tomorrow, but it's fun. It's enjoyable. There's nothing better than it. And we're not sleeping. Like I told you before, it's the makeup crew that did my makeup before the podcast.
I think I need them too. I'll just click the little filter on here to help out with that. I don't have a baby for an excuse. I don't know what my excuse is, but all right, man. I appreciate it, and we will see you on here next month.